Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, we talk interest rates with Chris Raymond from Unconditional Finance. We talk about what do interest rate rises mean to you as an investor and also as a homeowner, how you should be thinking about this time in the market, what opportunities may exist for you as a property investor, how you should be thinking about your debt strategy and your property strategy. We covered a lot of ground. We talked about, some of the facts that are going on in the market, but also some of our own personal opinions on what we think is going to happen in the market as well. So I particularly enjoyed this episode. We did a little bit of forecasting into the future, which by the time you listen to this, you're going to know whether or not we were correct. But I'm pretty confident on where we think things are going. So if you have any concerns about what interest rate rises mean for you, then this is the episode that you need to listen to because it's really great. We covered a lot of ground and we debunked a few myths in there as well. So without any further ado, actually, before we jump into it, if you have any questions that you would like asked and answered on the show, you can send those questions through to til@dashdot.com.au. That's til@dashdot.com.au. Send us through any questions you might have about your own personal property strategy, what's happening in the market, or anything you just want to know that we can talk about on the Investor Lab that could help other people as well. And of course, if you've enjoyed this episode, or if you enjoyed this podcast in general, then please share this with a friend, family member, or loved one. That's how you can help us. The goal of this podcast is to empower you to be a better investor. And if you can empower somebody else, then that's going to mean the world to us. So without any further ado, let's get stuck into it. And I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is Chris Raymond from Unconditional Finance. Chris, we're going to be talking today about interest rates.
We are. The topic of, I think, everybody's conversation at the moment, politicians, it's in the media. So definitely a topic or a good topic to discuss today, Goose.
Totally. So as we record this episode, it is the 3rd of June, right? I don't normally kind of date stamp this, but it's kind of hyper relevant in the context of the current conversation because last month there was an interest rate rise, right? And that I think has triggered a lot of property investors in particular and home buyers and has put their heads into a bit of a spin. And the reason I thought we could date stamp this episode is really interesting is because there's going to be another interest rate announcement next week, so 1 week from now,
Tuesday,
which is actually going to be after this podcast. This podcast episode is going to come out after then. So we're going to we're very tight to a kind of a decision point there, but we always record a little bit in advance. So, mate, I'd love to get your perspective though. Obviously we had an interest rate rise last week, and we've got I would actually love to get some insight from you because as far as what I can tell is banks are actually raising interest rates much more than the RBA is raising interest rates. So, mate, do you want to talk about how you see the landscape from your perspective?
100%. Yes. So I guess the first Tuesday of May it was. So we're in June at the moment. So so that was the first RBA increase since 2011. So a lot of people, a lot of our investors, a lot of listeners on the podcast today, they haven't actually seen that before. They haven't actually gone through a rate rise. So that was quite interesting. That was mainly driven, you probably read a lot about it in the media and things like that. It's mainly driven by the inflation rate. So inflation's obviously the cost of living, the cost of, expenditure, and that's quite high at the moment. So that's what drove the initial interest rate hike. Now, like you said, Goose, we've date stamped today's podcast, and obviously the RBA is meeting again next Tuesday. Interesting commentary around the industry, around what they're going to do. I personally think they may go again. They may increase rates again. There's sort of commentary of, 25 points, 40 points, et cetera, et cetera. So, there's a lot of sort of, I won't say concerned clients, but we are getting a lot more calls now, almost on a daily basis. Chris, do I look at fixing our loans? We're on variable at the moment. What's the fixed rate market doing? What's variable rate market doing at the moment? So there is a lot of activity in the market, but we'll obviously unpack that today.
Yeah, I think it's a pretty interesting thing to point out there that it's the first time the RBA has raised the cash rate since 2011. So that's over 10 years, right?
Yeah.
It's over 10 years. And I think that a lot of people have kind of forgotten that because you're right. If you have started investing sometime or buying property sometime in the last, 10 years or whatever, you have never experienced a time where interest rates have gone up. And I think that is one of the key factors. Even if you have experienced it before, even if you're a more, you've been investing for a longer period of time, it has been so long. I mean, Chris, can you tell me what were you doing 11 years ago?
It's a lot younger. I was investing, but yeah, I guess basically you're probably looking anyone sort of, 30, 35 years and below, they haven't actually experienced a rate rise. So it is.
Mate, I couldn't even tell you what I was doing 11 years ago. I couldn't even tell you. I was like, I don't know. Like, geez, I'd have to really scratch my head and think about it. Like, what was I even actually doing? Was I like, and this is kind of the point, is like, we don't even actually remember back that far, right? So,
correct.
So even if you're 50 and you were buying property back then, your internal kind of like psychology it's been so long. Like imagine 10 years gap in anything, you're gonna be a bit rusty on how does this work again, right? And so
correct.
The interesting thing as well is that the current cash rate as of today, so the RBA interest rate, is 0.35%.
Yes. Yep.
That is on a global economic and historical standard obscenely low. Like that is like it wasn't actually that long ago that it was the first time that it got down to 0.35%. That wasn't that long ago at all, right? And when that happened, everyone was like, "Oh my God, the cash rate's going to zero. This is crazy." But it was because the momentum was downward and we hit 0.35%. Everyone lost their minds because they were like, "Oh my God, how cheap is the money?" But then now it's gone one step further and then one step back, and everyone's kind of having a little meltdown. They are. Which I think is really interesting. Now, yes, you said another thing there, that there's talk about it raising 25 to 40 points. That's 25 to 40 basis points. Do you want to just explain that so that people can understand, like, how much is that of a percent?
Yeah, I mean, 25 points is 0.25 of a percent. So it's still, it's still not a substantial sort of increase. I'm just looking at some data here. I mean, on a sort of $500,000 loan, a 0.25% increase is around $69 per month. Uplift on your minimum mortgage repayment. So it's still not a huge amount. There is commentary. The RBA may come down a little bit heavier, so 0.4%. My personal prediction is I think they will go a little bit more cautious. I think the RBA commentary is a little bit more cautious than what the banks and a lot of the bank economists are coming out with. But yeah, I mean, it's not an overall huge increase to your daily budget. Keeping in mind, Mr. Client, as well, or clients that are listening today, the banks are stress testing you, around 3% higher than you're actually paying. So yes, it's a little hit to your family budget, but in terms of affordability, the bank has already stress tested you, over a benchmark interest rate of around that sort of 6 to 6.5%. So you can afford it. It's just obviously adjusting, your family budget in line with those small increments.
That's a really interesting thing you point out. And another thing that I think people are forgetting, right, is that you get stress tested about 3%. Is it sometimes 2% or is it always 3%?
It is 3% now. Yeah, it used to be 2.5%, and then APRA, I guess, 4-star, the deposit taking institution. So all your major type first-tier lenders to have a 3% buffer. So there is margin there, and the bank has stress tested you on that higher rate. So yeah, affordability-wise, the bank says you can afford it. As I said, it's a bit of a lifestyle adjustment, but for what it was, $69 a month, it's not a huge amount of money.
Totally. And that's really interesting, right? Because a lot of people, I think one of the things that people believe, like if you listen to the media, interest rates are going up and property prices are going to crash and all of that kind of stuff. Yep. Now, property price, we also just heard recently that nationally property prices have fallen for the first time since September 2020.
Correct.
Which is really interesting because actually it's only Sydney, Melbourne and Canberra that have gone down. All of the other capitals and all of the other regionals are still going up. So
correct. Yeah. And not only that, I mean, you're seeing it now, Goose. We're seeing it with our clients as well. I mean, obviously that presents different opportunities. So a lot of our investor customers now are, they're moving to Perth to obviously buy properties. South Australia is getting a look in as well. So, with interest rate increases, yes, the east coast of Australia may impact it or maybe impact it a little bit more. But there's opportunities for, cheaper price points, higher yielding properties, different states that haven't had sort of growth for, 5-10 years.
Yeah, 100%. But one of the interesting things about that is people, I think, psychologically believe that because interest rates are going up, it's less affordable, right? And all of a sudden, everyone's going to have to start selling their houses because, oh my God, the interest rates have gone up and they can't afford to hold their houses anymore.
Yep. Yep.
But to your point, right? So there's like the most alarmist kind of like forecast that I've seen is that interest rates are going to go up 2.5%. That seems to be the outside one that I've kind of heard. But the thing is, even if they do go up 2.5%, to your point, banks have stress tested your ability to borrow at 3% higher anyway. So
correct.
Even that shouldn't result in any kind of like massive fire sale on properties or anything like that. So it seems a bit of a weird one. That being said, why? So banks seem to be putting up interest rates faster than the cash rate, though. So what's going on there?
Yeah, variable rates, no. So, I mean, obviously on the back of last month's RBA increase, they did all go in, pretty much they all went into the line. There was a few sort of what we call third-tier lenders that sort of increased higher than the 0.25% increase, but the fixed rates have been obviously going up. Now, the fixed rate funding is a little bit different to obviously the variable rate funding, so that's part of the reason. I guess the banks are trying to forecast where the interest rate or the cash rate might be in 2 or 3 years' time. Yes, there's probably a little bit of profiteering going on there. So people in these times, Goose, I guess, get a little bit panicked. And, it's like selling in a low market just through panic. It's obviously, interest rates are starting to go up. I mean, to me, the fixed rate party, it left around 7 months ago, October, November last year. So
what do you mean by that? What do you mean by that? Just to explain on that. What do you mean the fixed rate party ended?
The fixed rate party. I mean, there was a lot of fixed rates in the mid to low 2%, 6 or so months ago. So when I say the party's gone, I mean the fixed rates have increased some 1.5% to 2.5%, depending on the lender and depending on the fixed term as well. So yeah, when I say the fixed rate party has left, people start to panic in these times and they start to look at fixing in a higher rate. This is where we need to do a comparison. Longer term over 2 or 3 years, is it better fixing in at an interest rate that's, some 2% higher than what they're paying at the moment? Or do we look at ways, variable might go up a little bit, but I still think longer term you would be in front in comparison to the current fixed rate. So there's little things like that. Yeah,
it's pretty interesting, right? Because there's 2 factors in there. There's like, what is the risk? If I go with variable, what is the risk that the interest rates are going to rise and I'm going to potentially end up paying more money, right? But there's also, if you go fixed, what is the opportunity cost of access to capital? Because when you fix it, like you're fixing the term of the loan, you can't refinance, you're going to have to pay break fees and stuff like that. That's right, yeah?
Correct. Yeah. And I guess you lose a lot of flexibility. So, I mean, at the moment, we are still, I guess, recommending, every client's circumstances are different, but the majority of our customers at the moment, we're still recommending variable. You're looking at least 1.3, 1.4% higher for the 1 year fixed rate. You're looking about 1.8, sort of up to 2% difference or margin between the current variable interest rates to the 2 year fixed rate. So it's going to take a lot of RBA increases over that 2 year or 3 year period to actually catch up to that fixed rate. And not only that, I think you touched on it just shortly before there, Goose, you lose a lot of flexibility with fixed rates as well. Additional repayments, it's not as, I guess, liquid. If you wanted to sell your property, you can't easily refinance if you're fixed in with lender A, but lender B comes back with a higher valuation as well. So they're all things to factor in. And part of the reason, the majority of our clients, we are still recommending, look at the variable rate market.
Yeah, and the other thing you got to think about that is, like, realistically, how long do we think that interest rates are going to go up for, right? Because interest rates are only going up as a response to inflation, right? And it's only to try and curb inflation, right, so that it doesn't get out of control. Now, I went and had a look at interest rates for since 1980, right? So I went and had a look back over it, and I had a look at all of the times that there was an interest rate rise. And I haven't got the data in front of me because I did this analysis a couple of weeks ago, but I'm pretty sure it was like the average or the maximum kind of time was like 2 years. I think it was actually like the maximum time was like 2 years that they went up for, and then they went down again, because it's actually in the best interest of the country to have a growing economy, and that actually is best stimulated by lower cost of capital and all of that kind of stuff. So if you really think about it, historically, it's like it's 1 to 2, maybe max 3 years would probably be the outside that the interest rates go up for. So then you've got to weigh that factor in there as well.
Correct. Yeah, and I guess people listening today, it's in the government's and the RBA's best interest. They don't want your house price, to diminish value by 30, 40, 50%, their interest is, I mean, obviously it's going to soften a little bit, but obviously they want the economy growing. They want more jobs. They obviously want, they want the economy, sort of standing on its own 2 feet. So they don't want to increase interest rates too aggressively, and they don't want to increase interest rates over a long period of time. So, yeah, I've got my thoughts in terms of sort of the time period. I think interest rates will sort of increase on, and then I think what's going to happen, I think the economy then may start to go into recession. Obviously government. Yeah, I personally think the next sort of 15 to 18 months, there will be rate rises. How high that will be, I mean, throw a dart at the dart. But I think anywhere between maybe, an additional cash rate increase of between sort of 1 to 1.5%. I think for the next 15 and 18 months, the economy will start, falling into a recession. And what I mean by that is people become concerned. They stop spending. They stop going to shops. Small businesses suffer.
Well, it's two quarters of GDP, negative GDP growth, right? That's all. Correct. That's all we're talking about. We had that recently, right? That wasn't a big issue.
Yep. And then I think in sort of 18 months, maybe to 2 years' time, the government's going to be forced to cut interest rates again. So what we don't want our clients to do is, they've locked in at a 5 or 5.5% or 6% interest rate. And I saw this in my early broking days 6 or 7 years ago. People panicked and locked in at 7 and 8%. And then obviously the variable rates were sitting at around 3 and 4%. And I mean, the break cost just to get out of them was, astronomical. You're looking to, $10,000, $20,000, $30,000 in some instances. So as I said, I mean, every client's circumstances is different, but speak to your broker. Let's weigh up what is best for you. And at the moment, we're recommending variable. And I think the time period for rate rises is between that sort of 18 months to 2 year period personally.
Yeah. So, and it's pretty interesting, right? That your view is that we might go into recession, because a lot of people hear recession and they think, oh my God, this is going to be so bad. I mean, but pragmatically, we've had a ton of growth, and in fact, for property investors, that actually isn't really going to matter anyway. And I mean, you said obviously, you used the words obviously things will soften a little bit in reference to property prices. I think is what you're referencing there. But very interestingly, I have been doing some pretty deep analysis on the whole interest rate thing.
Yep.
And median sales price growth, right? So the percentage rate of change, not median sales price, right? So not the prices, but the growth rate, that goes all over the place, right? And it's completely uncorrelated to, or generally uncorrelated to interest rates. However, in all of the times that we went into a negative growth, right? Negative growth rate, which means actually property prices have gone down, right? All of those correlated with a time where interest rates were also going down, not up. So the only times in the last 30 years where median growth rate has gone negative has correlated actually with the time where interest rates are going down, which is really interesting, right?
It is.
And it's really, truly fascinating. And I think that one of the reasons that people get so freaked out about it is because you have in the media, you have a lot of economists and stuff saying, interest rates go up and property prices go down and all of this kind of stuff. And the economists are the ones that get a lot of airplay in the media. Now, I was having a bit of a think about it. I was actually talking to Gabby about this morning, and I said, it's absolute nonsense. She said, well, why do people believe that? And I said, well, okay, because mostly it's economists that are saying that this thing's going to happen. And economists see the property market the same as they see the financial markets, right? Which is just not the same, because in the financial markets, in the financial sector, like business and shares and all of that kind of stuff, as interest rates go up, profitability goes down, values go down, right? That's the impact, right? So if you look at the stock market correlation with interest rates, interest rates go up, stock market goes down, generally speaking, right? But the thing is, real estate is not the same as the financial market. And so you've got these people making commentary based on it being a type of market that it is not. And therefore, that's why they get it wrong, which I think is pretty interesting. What do you think about that?
No, I completely agree. It does correlate with the share market, obviously business as well. So keeping in mind, I'll have a sly little dig there. These are the same economists that were predicting 15 and 20% decreases in property values across Australia, as COVID obviously hit as well. So, and it is, it's throw a dart at the dartboard. I mean, you look at each different bank, their chief economist has a different opinion on what's going to happen. So my advice to our listeners: don't read the papers. Seek advice from your property experts like Dashdot and yourself, Goose, and obviously your brokers, and make sure you've got buffers in place. Make sure your loans are actually set up correctly. To navigate this, this what I'll call a small interest rate rising period. But just get everything checked over. So.
Would you know, like the last time that interest rates rose by 2%, property prices doubled in many parts of the country. Right, this is the thing that people don't get. Right,
so no, I think it's I mean, with interest rate rises as well comes buying opportunity. Yeah. So I think now is the time in the next few years, 1 or 2 years, where you could really purchase good properties in good suburbs in good states, and when hopefully the interest rates start coming down again in 18, 24 months time, consumer confidence comes back, your first home buyer market comes back, the investors, not the professional investors, but the mum and dad investors come back in the market, obviously overseas immigration, the buying opportunities that you create for yourself in this, small period of time over the coming years is going to set you up for good growth.
It's a really good point, right? That is a really good point you made. And I'm going to expand on that a little bit because like from what I can say from the coalface, right, is that what is being said in the media is absolutely not true. It is still ridiculously hard to buy properties in the places that it is worth buying properties.
Correct.
Like the buyer activity is still high, like things are still like most of the country is still, still cracking on, like nothing's changed. But the interesting thing about what you just said there is the buying opportunities and who's going to return to the market, right? So, and I'd love to get your point of view on this as well. So, from my point of view, right, interest rate rises affect homeowners more, right? Because investors, they have the income coming in on the property, and what typically happens when interest rates go up, because of the serviceability buffer that we talked about earlier, that 3% assessment rate, right? If the interest rate goes up, that means the rate at which you're going to be assessed about whether you can borrow, also the bar gets lifted, right? So for people who are trying to enter into the market as a homeowner, right, that actually makes it harder to enter the market because
completely agree,
because the bar's been raised, right?
Yep.
Now, if also we have a housing shortage in Australia, which we do, then that pushes more homeowners to continue to rent, right? Which actually pushes more pressure into the rental market, which
absolutely
also drives up rents, right? And so if you are buying to invest, then actually it works out to be significantly advantageous. But then what happens, right, is that as interest rates go down and rents stay the same or continue to go up, but they probably won't go up as fast. They'll probably, they generally revert to the mean, right? But then homeowners push into the market, and homeowners drive markets more than investors do statistically anyway. So for an investor, this is like prime opportunity to get into the market, to be able to capture that opportunity. And then as interest rates fall again and homeowners are able to push back into the market as well, then that's going to push up prices even further. So I'd love to get your point of view on all that.
I mean, you'd probably have data. I know my portfolio across Australia, it's all, rents have gone up 10, 15, 20%. Pretty much all my clients, Chris, our rent's gone up. And, can you check our serviceability? The other point to note there as well, Goose, is all investment debt interest-only investment debt is tax deductible as well. So investors, like you mentioned before, it's more the owner-occupied market that feels the impact with any rate rises.
Yeah.
Yes, all right, as an investor, your rents are rising, which is good, but any investment interest debt on that home loan is tax deductible anyway. So, it definitely has a less of an impact for the investor market.
Totally. So if you're a rent investor, this is like, this is great, right? As long as you've got a secure lease, right? Because rents could be going up, but it could be a good opportunity for people to be thinking like, okay, with all of the remote work, and we were actually just talking about this before we came online. What an awesome opportunity to maybe assess, well, where am I living, and am I living my best life, and could I move to somewhere else potentially where the rents are a little bit cheaper, right? And move to, and this actually is also what is driving markets all around the country and why regional markets are still performing strongly, right? Because people have got that optionality to move around and rent somewhere else and then continue to invest. So I think this is an absolute golden opportunity. I think this is really a golden opportunity, because the other kind of part of this is the inflation piece as well, right? And
Correct.
so,
Yep.
we're talking about how the interest rate situation is actually creating opportunity, but the other secondary effect is the only reason interest rates are going up in the first place is because inflation is high, and as inflation goes up, property prices go up. Like there's a direct correlation between interest rates and property prices. So. Getting into the market now has got the double whammy effect that your property prices are going to continue to go up, and also you're likely going to be capturing higher rents, which is pretty interesting. So what advice have you got for people that might be like a little bit concerned about kind of, like, have you got any other kind of insights or anything from your side of the coalface?
Yeah, I mean, speak to your broker, get your interest rate or get your portfolio checked in terms of, there's a lot of incentives at the moment to refinance. There's a lot of incentives to even go back to your own bank and negotiate, or get your broker to negotiate on your behalf. So, ask yourself the question, are you still getting the best deal for yourself? The other thing is, look at your portfolio. One thing we do as well is, are you maximizing your money in the best possible way? Yes, there might be a rising interest rate environment, but we often see a lot of clients that have got their owner-occupied debt. They've got 2 or 3 properties. They've got it all on principal and interest repayments. Is that maximizing, your portfolio or your cash in the best possible way? And we would normally say no to that. Your accountant would say no to that as well, because ideally you want to be paying down that non-deductible debt, that bad debt, which is your owner-occupied debt. So that home loan where you live, that's the debt you ideally want to be paying down. And whilst you have that debt, you want your investment portfolio on interest only on most occasions. So little things like that, if you are concerned, speak to your broker, review your interest rates. Are there little things like that we keep that bad debt on P&I, and we switch the investment loans from principal and interest only as well?
Yeah, because the secondary effect of that, right, is let's say you own a principal place of residence, right, and we'll call that the bad debt, right, as you put it, because it's non-income producing, non-tax deductible debt.
No tax deductions.
So it's it serves a purpose, typically an emotional purpose, right? And that's fine. There's absolutely nothing wrong with owning a home and everything like that. It's all good. Everyone has those kind of needs. But in practice, if you can then put your investment portfolio on interest only, and you can give that advice. I can't give that advice, but if in theory. If you did do that, then you're actually going to be maximizing your cash flow from your portfolio, and then you can use that cash flow to pump that back into your principal place of residence to actually pay down the non-income producing, non-tax deductible debt, which 100%. Can actually then improve your serviceability, because you haven't got that kind of black hole on the balance sheet.
Exactly.
So then that actually becomes a bit of a cycle and another way to win.
Completely agree. And we see this daily. So it's about, in times like this as well, it's a good opportunity to pause, have a look at your portfolio, have a look at your home loans. Are your debts structured in the best possible way, like we just mentioned? So not only from a cash flow point of view, to pay down the bad debt, for, maximizing your tax deductions, but also cash flow. Obviously, interest-only debt on investment you're going to be paying less each month in comparison to principal and interest. So if you are concerned, reach out to your broker, reach out to your banker, reach out to us, and have a review.
Let me ask you a question from your personal perspective, not advice, but just your personal opinion. Would you put your property investment portfolio on interest only forever if you could?
No.
Why? And why? No. And at what point? And this is just your personal. I'm after just your personal opinion.
Yeah.
At what point would you consider, because it obviously makes sense for a period of time, but at what point would you consider, in theory, switching it to P&I, and why? Yeah. Why wouldn't you go just interest only forever?
Yeah, good question. I mean, what we just spoke about, the good debt and the bad debt. So like my scenario, I have bad debt. I have an owner-occupied debt. So, I'm maximizing my, cash, my rental income. I'm getting everything. So all my rental incomes are going into that offset against the bad debt where I live. That's the only P&I debt on my portfolio at the moment. And my investment debt is all interest only. But at some stage, once that bad debt is paid off, we do obviously want to reduce debt. I don't want to, in 10, 15, 20 years' time, still have the same debt levels that I currently have. So we do look at then debt minimization strategies. Not for everyone in terms of that complete structure, but I would say 90% of our clients we're recommending that similar. If they've got a principal place of residence, that's what I'm doing.
That's a great
what we're
insight.
recommending to our clients as well.
That's a great insight, because that's a really interesting trigger. And again, your personal, if you're listening to this, your personal situation may be different or whatever. So this is an in principle kind of theory-based discussion. But that's a really interesting, because people might be thinking, oh, well, when do I pay it down? And that's a really good inflection point that you've pointed out for you personally. It's like, well, when my property investment portfolio has paid down all of my principal place of residence debt, and I no longer have any bad debt, at that point, that would be the inflection point at which I would decide to pay down the property investment debt. That's a really cool heuristic for people to be thinking about. I like that. I like that a lot. Now, another interesting thing you said there, though, is about you wouldn't want to keep the same debt levels forever. And I would actually argue, why not? Right? Because, right now, let's just say in theory, right, you've bought 5 properties on 90% LVR, right, on the day that you bought them, right? And so, okay, so that's pretty high debt level on the property. But then fast forward 10 years or something like that, if you haven't continuously raked out all of the equity, the LVR on that property is probably going to be, I don't know, 30, 40%, maybe less, right?
Correct.
So the relative amount of debt that you have on those assets would be really, really low. And because I even remember Josh Frydenberg, before the recent election, obviously, right, when he was talking about how to get the debt levels nationally back on track. He wasn't talking about paying down the debt. He was talking about growing the economy. He's like, well, all we need to do to lower the LVR basically is increase the value. So, and the same thing happens in your property, right? And the same thing happens in your property. We've had the same thing happen, right? Our LVR keeps going down. Why? Because our properties keep going up in value. So in theory, right? In theory, why would you, like, given a long enough time frame, 100 years or whatever, if you never paid down any of the debt, maybe you would end up with, I don't know, 1% LVR. Like, it would be so insignificant it wouldn't matter, but you would technically still have the same amount of debt. So I'm wondering why that matters to you personally. Like, what's your mindset on that?
Well, hopefully I'm here in 100 years, Goose. We'll do another podcast to reflect on our commentary today. So, no, it is. I mean, it does depend on the client. You are correct. Some people do not want to pay down debt levels. Some people do. It's a mindset thing that they don't want to have, whether it's $1, $2, $3 million in debt hanging over their actual head. Depending on the client strategy, some people may sell an investment property and then clear some of that debt as well, to obviously get, higher rental yields, or it might be rental income for your retirement. So in theory, what you're saying is correct. I guess the risk or the LVR profile, even if you're not paying that debt off after your bad debt's paid off, it is still minimizing that risk. So it just depends on the client, depends on the circumstances. So depends on the end strategy, really.
Interesting. And from a strategy perspective, let's talk about that. What do you think is the optimal kind of strategy in the current environment? Is it like buy as many properties as you can right now, let them all grow, and then sell some down, or like, what do you, personal opinion, because every situation is different, but what do you reckon?
Most clients are still in the accumulation stage. So I mean, you'd probably talk better on this than myself, but looking at my own portfolio, you've got the accumulation stage. You're building your foundation property portfolio, and then it might be, the hold stage, and then it might be, all right, what's the exit strategy stage, or do I pay down the debt stage, or do I sell a couple of properties stage, which we just spoke about as well. So I honestly think it's still a good buying opportunity time. I'm still buying. I've got a settle one actually happening this month, sorry. So, I'm still in the market. That, hopefully that gives a few of our listeners a little bit of confidence that I'm still buying. A few sort of mentors that I look up to, they're still buying. It's good buying opportunities as well. So,
all the smart money's still buying.
All the smart money this is where the professional investors come out. The mum and dads pull back from the market. The professional investors come out, nab some good bargains, and this is where they're going to reap the benefits in 2, 3, 4 years' time. I mean, historically, look at house price growth across Australia. I mean, there's a shortage of housing supply. You've probably got the data on that. Immigration, we've had records levels of sort of growth in the East Coast in the last sort of 24 months. But I mean, that's with no immigration either. I mean, immigration's just starting to come back into the country as well. So there's all these drivers. Yes, interest rates are rising.
Yeah,
that still point to
We
Good times.
had a deficit nationally of 144,000 houses before COVID. We were 144,000 houses short of what we needed, which is actually pretty significant, right?
Yeah, and the other point of that is, I mean, there's little incentives now for first-home buyers. I mean, the Labor government just got in, so that's going to bring a whole new, whole new level of, I guess, clientele into the market.
But people can't build houses; they can't get the materials, right?
Well, that's the other point as well, because housing prices have gone up 20, 30, 40%, and a lot of our clients were building. I mean, the builders have had to say, due to a shortage of supplies, your house price has gone up. So people are now putting their handbrake on building house prices. What does that do?
Yeah,
it puts pressure on a supply issue.
Yeah,
and then obviously in turn you get that growth. So I guess, I mean, every client's circumstances is different, but don't be alarmed by what you're reading in the media. Review your portfolio. But it is still a good buying opportunity. I think that the people that, lay the foundations down for their portfolio in the next 12, 18, 24 months are the ones that are going to reap the benefits in, 5, 10 years' time.
Yeah, awesome. So let's do a quick recap. On this, because I think there's some good stuff in there. So basically, interest rates have recently gone up, and they're probably going to continue to go up, right?
Yep.
Your general modus operandi, again, caveat, every situation is different. Cool. So this isn't financial advice, right? But generally speaking, you're suggesting it's more advantageous to be on variable rather than fixed at the moment.
Correct. Yep.
Generally speaking as well, you're suggesting interest only is going to be better, particularly if you've got bad debt to pay down, with bad debt being a principal place of residence.
Correct.
Debt or non-income producing, non-tax deductible debt, whatever that may be to you, and just to, and to pay that down. And basically, and realistically, interest rate rises are probably going to be relatively transient. Like property, if you're investing in property, you shouldn't be thinking in 2-year cycles anyway.
Correct. Absolutely. 5 and 10 years.
Exactly. And realistically, interest rates is going to be relatively transient, probably drop in the next kind of 2 to 3 years anyway.
Exactly. Yep. And keeping in mind, oh, sorry, go on, mate.
You go.
No, I was going to say the point we touched on at the start. I mean, the banks have already stress tested you 3% higher than you're actually paying. So they were already stress testing. They were forecasting, well, not forecasting, but they were factoring in if interest rates were to get to 6.5%. Can this client actually afford it? And the answer is, if you had your loan approved, it's yes. So
totally. And the other piece of that for investors, right? The other piece of that for investors is that, and we kind of touched on it really lightly, is that that rents are rising a lot, right? So nationally, rents have risen by like 10% over the last 10%. They've risen on average 10% over the last year, but in actuality, right, in practice, they've risen in many areas by up to 20%, which is crazy. So when you think about what that means in terms of serviceability, your capability to continue to borrow, the actual income impact of that, right? That doesn't mean that necessarily from an investor's perspective that investing is any less affordable than it ever was, right?
Correct. Yeah.
Awesome.
So a lot of those rent rises, I mean, they're I guess, they're absorbing. They're absorbing, any rate increase anyway. So, like, I know a lot of clients have bought in Queensland. I've seen rents jump $80 a week for the same properties up there. So it's going to take a good sort of 1 to sort of 1.2, 1.3%, interest rate rise for you to actually be behind, given those rent increases, I should say. So
100%, mate. I love it. We've covered a lot of ground here today. I've actually really enjoyed this episode. It's good. Debunked a few
this
things
is your
about
kind of stuff, isn't it, Goose?
Yeah, I love it. Right, it's one of my favorite topics is like interest rates of property, because people just don't get it, and the media says one thing, and the truth is just like basically the complete opposite. And so I think it's been really good getting your perspective on specifically on like how to navigate this, how to be thinking about it, all of that kind of stuff. I think that's really good because most of it's a mindset game. Like property investing is a game of finance, but success is all one in the mind, right? And so how you navigate the way you think about your environment and the decisions you make is going to dictate how successful you are in life and what your future looks like. And this is another example of being able to of the need to be able to cut through the noise and be able to have a really good mindset as you go through this kind of period, because it could be quite scary for some people. So
absolutely, yeah. So don't panic. I won't say don't read the media, but don't read. I mean, the papers, they sell papers by alarming alarming
bleeds, it
headlines.
leads.
Yeah, absolutely. So don't read everything. Don't believe everything you read in the paper. Review your portfolio. It's a good time to check. Is my loan or are my loans structured in the best possible way, which is what we discussed obviously earlier. Reach out to your broker, reach out to your banker. Am I doing things in the right way? Right, maybe I'm on a higher variable rate at a different bank. Can I, negotiate with my current lender? Can I refinance? There's obviously a lot of incentives to refinance. Some banks offering $3,000 and $4,000 incentives to move banks. So yeah, don't panic. Good buying opportunity, in my opinion, over the next sort of 15, 18, 24 months. And then I think we'll start to see interest rates then start to come back down after that time period. So.
Totally. Well, I actually think what an exciting time to be alive. I think all of this is really fun. So, Chris, mate, I've loved it. Thanks so much. And if anyone wants to reach out to you directly, get some wants to connect with you or the team and maybe get some advice on their current situation, how do they do that?
Yeah, Unconditional Finance, based in Sydney, service clients all over Australia. So unconditionalfinance.com.au or Chris at unconditionalfinance.com.au. Reach out. More than happy to give our thoughts and give our expert advice, and look forward to chatting again, Goose. And just quickly, what's your pick for next Tuesday, RBA?
I think the cash rate's going to go up. Yeah, yep. I think the cash rate's going to go up. But again, I think that people need to keep that in context, right? And it kind of touched on it at the start. Like the current cash rate 0.35%, and I remember when it got to 3.5% on the way down and people were freaking out going, oh my God, it can't go any lower. This is just crazy. So to your point, even if it does go up 25 basis points or even 40 basis points, right, which would be 0.4%, would be up to 0.75%, would still be below the 1% cash rate. And that cost of capital is just like it is crazy cheap. Like it is ridiculously cheap on a global historical basis. So I personally think it's going to go up, but I kind of couldn't care less. Like, like I don't want to sound too blasé about it, but I'm not a homeowner, and I'm not planning on being a homeowner anytime soon. I like rent vesting. I like the optionality. And I'm a property investor, and I see more upside than downside. And for all of the people that it negatively impacts, I feel sorry for those people, and I don't wish that I don't want any badness or anything. I'm like, yeah, cool, great, let's have at it, because what I care about is a healthy, sustainable economy, right? Correct. And a healthy, sustainable economy has to have checks and balances, and we have to do things at different points of time. Sometimes it's cut the cash rate, stimulate growth, and sometimes it's increase the cash rate to slow growth down a little bit. And that's all. It's like driving a car. You can't put the foot to the accelerator the whole time. Sometimes you've got to brake to go around a corner. But I don't. Yep. I think it's going to go up. But what do you think?
I agree. But I mean, just quickly, just before we do finish, I mean, even 0.4%, even if it does go that high, your average sort of investment loans around that $500,000 mark. That's only sort of $100, $110 extra per month, $25 a week extra, which is all tax deductible. And in most occasions, your recent rent rises would have absorbed that increase. So it's not doom and gloom. So yeah, we don't want to see bad on anyone out there. If you're struggling, there is means to speak to banks, and there's financial hardship and stuff like that. But for investors, it's minimal impact. Even if they go aggressively, which I don't think they will, 0.4%, I think personally they'll go 0.25%. But yeah, it's minimal impact, $25 a week increase to your repayments. That's it.
I couldn't agree more. And it's great to put some actual numbers to it there as well. So thanks for that, Chris. I appreciate it. Mate, I've loved it. Loved having you on. Let's do it again soon. Thanks for your time.